Welcome back to the deep dive. You've handed us a stack of sources, corporate filings, accounting textbooks, and our mission today is to give you a shortcut to genuine financial understanding.
We're diving deep into the foundations of financial accounting, the three core statements that really define a company's past and help forecast its future.
Exactly. The goal is to move beyond just simple definitions and see how these statements reveal the strategy, the risk, and the real economic story pulsing inside a huge corporation.
And we'll be using a running case study for this deep dive.
Right, the 2024 financial reporting from McDonald's Corporation. This lets us ground all these abstract rules of accounting in the very real, very complex world of a global titan.
That's the perfect example.
Okay, let's unpack this. Starting with the absolute foundation of everything we're going to look at, the accounting equation.
It really is the single foundational law of business. Assets equal liabilities plus equity. It's often called the immutable identity because it has to always be true.
It seems so simple on the surface.
It is, and that's its power. It's the mechanism that forces a company to account for everything it owns, its assets, by tracking exactly how it was all paid for.
So either with money it owes to outsiders, which are the liabilities, or money from the owners themselves, the equity.
Precisely. And the simplicity makes it really powerful. The sources use a great small-scale example.
Yeah.
Say you start a delivery business. You buy a van for $20,000. That's your asset.
Okay.
If you took out a $15,000 loan and then put in $5,000 of your own savings, the equation it balances perfectly. The van is fully accounted for.
And the mechanical reason it always balances is something called the double entry system.
Exactly. It was a technological revolution perfected over 500 years ago. Every single financial transaction has to affect at least two accounts. It has to. That's what maintains the equilibrium.
Can you give us a sense of how that works in practice, maybe for a bigger company?
Sure. Think about buying a new piece of equipment. If a corporation buys say a $10 million machine using cash, the asset account equipment goes up by $10 million, but another asset account, cash, goes down by the exact same amount.
So total assets don't actually change, the equation holds.
It holds. Or if they buy that same machine with a new loan, their assets go up and their liabilities go up by the same amount. The genius of it is that if you're keeping honest records, it's almost impossible to record something without keeping that balance.
So that's the conceptual power. But now let's get to McDonald's. Because when we look at their 2024 balance sheet, the equation is, legally balanced, but the story it tells is, it's provocative.
It really is.
Yeah.
They had $55.18 billion in assets.
$55 million.
And on the other side, they had $51.95 billion in liabilities. That's mostly debt. And then an equity balance of negative $3.80 million.
A negative number. That's the part that jumps out. How can you have negative equity if you're a company as successful as McDonald's? Shouldn't it be huge, reflecting decades of profit?
Logically, you would think so. But strategically, no. And this is a story of extreme leverage and really aggressive shareholder returns.
What do you mean by that?
The company made billions in profit over the years. But instead of letting that profit just build up in the equity account, management used the cash it generated to do massive stock buybacks.
So they were returning capital to the owners?
Aggressively. When a company buys back more stock than the net profit it's retained, it can actually drain that equity account, pushing it into the negative.
So it's a deliberate choice.
Oh, absolutely. It screams that the company sees cheap debt as a better way to fund itself compared to just holding on to its profits.
Okay, so that raises a big question. If liabilities are funding almost all of the assets, what does that say about their flexibility, if interest rates keep climbing?
It tells us they're playing a high-risk, high-reward game. This kind of setup really benefits the remaining shareholders because their returns get amplified by all that debt. But it also shifts the risk profile dramatically.
Onto the creditors?
Exactly. The bondholders who are supplying most of the capital. If McDonald's cash flow were to ever falter, servicing that $51 billion in debt becomes a huge vulnerability.
But our sources also make it really clear that this negative number is kind of misleading when you think about the company's true worth.
Absolutely. We have to talk about this modern nuance. Accounting rules are fundamentally conservative. So accounting equity is very different from true economic equity.
How so?
Well, think about the McDonald's brand, the Golden Arches. That brand value is estimated to be over $40 billion.
Wow.
But under conservative accounting rules, that value, which was built internally over decades, it's just not on the balance sheet. If you added that economic value back in, their equity would be massively positive.
So the statement shows their debt strategy, but it hides their biggest asset.
In a way, yes. So that gives us a snapshot, their financial identity at one moment. But money has to move, and that brings us to the dynamic part of the story, the statement of cash flows.
If the balance sheet is the photo, this is the movie.
That's a perfect analogy. It shows exactly how cash was generated and spent over the year. It's all about liquidity, the ability to pay the bills, which you just can't see on the balance sheet. And we break it into 3 channels.
Right, so let's walk through those 3, focusing on the strategic question each one answers.
First up, you have operating activities. This is the core viability check. The question is simple. Does the main business actually generate cash?
So cash from customers versus cash to suppliers and employees.
Exactly. If this number isn't consistently positive, you don't really have a business long term.
And the second channel is investing activities.
This one is all about the future. It asks, is the company putting capital to work to grow? This is money spent buying new property, upgrading technology. For a company like McDonald's, you'd expect this to be a net cash outflow.
Because they're reinvesting, not selling things off.
Right. They're in a growth and maintenance phase. And finally, you have financing activities.
This one feels like it connects directly back to that balance sheet strategy.
It does. It summarizes the whole debt and equity story. It asks, how is the company funding itself and rewarding its owners? This is where you see the cash impact of taking on new debt, paying dividends, and in McDonald's case, those huge stock buybacks.
So the sources really hammer home that this statement is the ultimate reality check. Why is it so crucial to look at this in contrast to, say, the income statement?
Because of something called accrual accounting. You can technically be profitable on an income statement, but still go bankrupt.
How does that happen?
Well, imagine you sell $500 million worth of services on credit. You record that as revenue. You look profitable. But if your customers don't actually pay you for 6 months, you have no cash to pay your own bills.
So you have paper profits, but no money in the bank.
Exactly. The income statement would show a profit, but your operating cash flow would be negative. The cash flow statement prevents you from being fooled by those paper profits. You really need both to see the whole picture.
And the McDonald's cash flow story is a perfect example of this in action. Let's look at their 2024 numbers.
It's just a machine. Their operating cash flow was a positive $9.45 billion.
$9.5 billion in real cash from the core business.
Yes. It confirms their franchising model is an incredibly efficient cash engine. Then, their investing cash flow was a negative $5.35 billion.
So pouring money back into the business, modernizing restaurants, technology.
It confirms that commitment to growth and maintenance. But then you get to the echo of the balance sheet strategy we talked about. Their financing cash flow was a negative $7.50 billion.
So they spent more on rewarding shareholders and managing debt than they took in from financing.
That's it. They take the $9.5 billion they generate, they cover their $5 billion investment needs, and then they aggressively return the rest, and then some to shareholders.
It's proof that they're a mature company that generates way more cash than it needs just to operate.
It is. And if we connect this to the bigger picture,
Yeah.
The sources show a huge strategic win here. Back in 2012, their operating cash flow was around $7 billion. The jump to $9.45 billion in 2024, that's a 35% increase. That jump validates all those past decisions, like focusing on the high-margin franchise model. The cash flow statement is the undeniable proof that it worked.
Which brings us to our third and final statement, the income statement. This is the one everyone focuses on, that bottom line number. But the path to get there is so much more nuanced.
It really is. The income statement is the final piece of the puzzle, confirming efficiency. But it comes with some, let's say, caveats. There are 3 key things to remember.
Let's start with the big one that separates it from cash flow.
That's accrual accounting. It works on the matching principle. You record revenue when you earn it, and expenses when you incur them, not necessarily when cash changes hands.
The goal is to match the costs to the revenues they help generate in that same period.
Exactly. It gives you a better picture of true economic performance than just a simple cash count would.
But this matching involves a lot of professional estimation. I mean, it's not just hard numbers. There's some subjectivity here.
That's right, and that's the second key insight. It involves judgment and estimates. Accountants have to make educated guesses. The classic example is depreciation.
Right.
When McDonald's spends billions on new kitchen equipment, they don't expense all of that in 1 year. They estimate its useful life, maybe 7 years, and then expense a piece of that cost each year.
And changing that estimate could dramatically change the reported profit, couldn't it?
Substantially. If management decides a machine will last 10 years instead of 5, the annual depreciation expense is cut in half, and net income for that year suddenly looks much higher. So that bottom line is really a professional best estimate.
And the third insight is about making sure that profit is, real and sustainable.
That's what we call the quality of earnings. High-quality earnings come from core, recurring, day-to-day business. Low-quality earnings might come from a one-time event, like selling off a building.
You can't sell a building every year to make your numbers look good.
You can't. An analyst always strips those unusual things out to focus on the sustainable profit engine.
So let's apply this to McDonald's 2024 net income of $8.22 billion. First, we have to look at their top-line revenue.
And this is so critical for understanding their unique business. Their top-line revenue isn't the $130 billion in global sales from all the restaurants.
No, it's the much smaller number.
It's the rents, royalties, and fees they get from the franchisees. It's a high-margin, stable, and very recurring revenue stream.
And on the way down to that $8.22 billion profit, they're deducting all those estimated items like depreciation.
Exactly. And they're also deducting that huge interest expense, the cost of carrying the $51 billion in debt we saw. Without accrual accounting, which lets them match those long-term costs to current revenues, the profit picture would be totally incoherent.
So when we judge the quality of that profit,
It's exceptionally high quality, it's recurring, it's operating driven, and it's backed by an even stronger operating cash flow of $9.45 billion.
when the cash is bigger than the profit, that's a good sign.
It's a great sign. The market trusts those numbers. And their net profit margin was around 33%, which just confirms how incredibly efficient that franchise model is.
So what does this all mean? We've looked at the static balance sheet, the dynamic cash flow, and the nuanced income statement. For you listening, how do you pull these three together into one powerful conclusion?
It means they tell one unified story that you just can't get from any single statement. The balance sheet defines their identity as debt-leveraged and high risk, but it hides their brand value.
Then the cash flow statement comes in.
And it confirms the business is a powerful cash engine, generating far more money than it needs. And finally, the income statement confirms the efficiency of it all, with those high 33% margins.
They all reinforce each other.
This raises an important question. The entire point of this analysis is to help people determine if the strategy deployed, the high debt, the reinvestment was successful, and how to fund future growth. The data gives us the evidence to answer those big strategic questions.
It really does. The story is crystal clear. McDonald's is a mature, debt-leveraged, and ruthlessly efficient cash machine. The success of their pivot to franchising is proven right there in the numbers.
Undeniably.
We talked about how depreciation, an estimated non-cash expense, is a key part of the income statement. For a final thought, I'd suggest you consider how interconnected these statements truly are. We saw McDonald's spent over $5 billion on investing cash flow. Try to track the depreciation expense that results from that spending. Where does that non-cash cost appear, and why does understanding its flow through all three financial statements matter more to a seasoned analyst than it might to the CEO? It's a fascinating exercise in connecting all the dots.